I will be the moderator for today's event, and as always, our goal is to continuously add value for our clients by helping to educate you and keeping you informed. Today's discussion will be hosted by Roy Williams, CEO of Prestige Wealth Management Group, John D'Angelo, Managing Director, and Paul, who serves as our Senior Portfolio Manager. This conference call will be in the listen-only mode and should last approximately 30 minutes. No participation is required, and there is nothing you need to do except sit back and relax. We will take care of the rest. We can't take any live questions during this call, but we do welcome your comments and suggestions. So at the conclusion of the conference call, please feel free to send us an email with your comments and our questions to pwm@prestigewmg.com. And with that, here's Roy.
Welcome, everybody. And Happy New Year, our first call of the year. Welcome to 2019, and I think today's the first day of spring. No? Someone had said at the gym it's going to be the first day of spring.
I think February 21st or March 21st.
I don't know.
We hope so.
We hope so. So, yeah, well, it was 20 degrees when I went to the gym this morning. But we're going to give a recap of the fourth quarter, which was obviously a very, very big challenge. Discuss Federal Reserve, U.S. economy, global equity markets, fixed income, any outlook, and finish with discussing in terms of adhering to the financial plan. First off, I was with a client in the last couple of days, and the client was very, very surprised how bad the quarter was and the month was. Historically, December, is a pretty good month. Everybody hears of the Santa Claus rally. Well, the Grinch came and stole Christmas from the Santa Claus rally this year. It was, Paul, you and I were speaking. You had stated it was the worst December since 1930-something.
Yeah, so if we look at the S&P 500 and the Russell 2000, both dropped, 14 and 20% for the quarter. That was the worst quarterly performance actually since 2008. But if we just look at December alone, that was the worst December since after the Great Depression, 1931. So, a very stark reminder that volatility, certainly works both ways.
That's coming off last year where we had, John, the lowest volatility year maybe in history.
Yep. It was a very quiet 2017. I think markets were quite complacent going into 18.
Yeah, and we also have to look at, as we, a lot of people, and looking at what happened last quarter, you have to remember last quarter we hit our best GDP, and, we were over 3% for the quarter, in the third quarter that reported in the fourth quarter.
Right.
So, it was challenging, and we're going to discuss as we go forward some of the challenges that occurred, to cause the quarter to be as challenging as it was. But, first we're going to talk the first challenge, Paul. We'll talk about the Fed, our Federal Reserve. We had an increase in December, and, their statements that they made after that increase weren't polite statements having to do with interest rates.
Right. Well, I think, we all need to be cognizant of the fact that, there are greater market forces at play than, just, the economic pulse of the U.S. global economy. Granted, we did see some weakness in some of the underlying economic data for the fourth quarter, and, there was a lot of geopolitical risk, a lot of headline risk that we had to overcome, namely trade. But at the end of the day, it was the U.S. Federal Reserve Bank that, really caused the volatility spike. If you recall, in October, we were wrestling with whether or not the U.S. would engage China in a full-on trade war. That stoked more volatility. Those concerns were quelled. We moved on, and as a result, we then it really just came down to the Fed. It came down to the Fed on the 18th.
Well, the sell-off started with Powell's first misstep of the quarter, which was when he used the term that rates were not near neutral. And when he used that term, I think that was a term that spooked the markets in October and continued on with the president's tweeting at the Federal Reserve Chair through November.
And we had an opportunity in October to hear Janet Yellen speak. And, my concern, with the Fed, and, again, this can change, is that they're using unemployment, not inflation, as their bogey of increasing rates as we move forward, just from a demographic situation with 10,000 people a day turning from 60 to 70. Verizon just had a huge downsizing at the end of the year, and those who retire aren't in the unemployment numbers. And many of those may want to continue to work. So that's a concern, but the Fed, actually, as the month went on, his statements actually changed a little bit.
Well, they did, and they did for the start of the year. So, getting to the crux, we have a rather complex chart here, but what it's expressing is the entire start of the interest rate cycle. Actually, it shows the prior interest rate cycle where the Fed hiked all the way up to 5.25%. We had the financial crisis, and then, of course, the Fed lowered rates all the way to zero effectively. And then there's a salmon-colored speck toward the bottom, which is showing an additional stimulus. So there's really two policies that the Fed effectuated this cycle. One was just lowering the federal funds rate. The other was, which we've heard plenty of in the media, quantitative easing, which is just a fancy word for the Fed buying treasuries and mortgage-backed securities to create ample liquidity. There's actually a study done in the Atlanta Fed by two individuals, Wu and Jia, that equated the amount of the Fed's expansion of their balance sheet to rate hikes. And effectively, the Fed expanded their balance sheet by $3 trillion. That was the equivalent of them actually decreasing rates 3 percentage points lower. So in all reality, before the Fed started hiking in 2015, we really had a negative 3% interest rate, so to speak. And I think that's where the primary concern is that not that the Fed decided to, hike for a fourth time in December, and we now have two more rate hikes slated for this year, but it was really their conjecture around managing the unwind or the reduction of their balance sheet. They do have an additional $800 billion of quantitative tightening or balance sheet reduction for this year. Now, Jerome Powell did state that he was going to be, a little bit more data dependent, sort of reverting back to Janet Yellen's position. So really, we want to be very cognizant of this because this is going to drive global liquidity. And if we go to the next slide, chart to the left shows all central bank balance sheets in aggregate. So really the primary ones, the Federal Reserve, Bank of Japan, European Central Bank, and the Bank of England. The total being the orange line, as you can see, the roll-off of the Federal Reserve balance sheet is really going to start to create, toward the end of this year, some constraints in liquidity for the global markets. So this is what drove most of the volatility. It was the fact that you have the Bank of Japan, the European Central Bank, which do not plan on raising rates until the end of this year by 0.25%, but have no intention of reducing their balance sheet. So in essence, the Federal Reserve was posturing toward going against the grain, being the only developed market central bank that wants to raise rates. And that has plenty of implications. One in particular, the more the Fed raised rates this year, the more our U.S. dollar strengthened. And the more our U.S. dollar strengthened, that put a lot of stress on emerging markets. It put a lot of stress on companies where they generate the majority of their revenues overseas. So, the Fed really is in the driver's seat here. Because, when you look at the market reaction, the amount of volatility that we saw in December in the fourth quarter, the underlying fundamentals did not dictate a retrenchment of that type.
Paul, it was a fear-based sell-off based on some terminology that the Fed chair used. He used the term autopilot, as an approach to handling quantitative tightening.
Right.
And with the global economic weakness that we've seen overseas, the market feared that if the Fed didn't manage their balance sheet more carefully, that potentially growth could slow, or we could end up at stall speed.
Right. So, one thing to understand, so the listeners out there, we during after the financial crisis bought our debt. It's an asset on the balance sheet of the United States. It's not a debt, it's an asset. And what they're doing is letting that asset, as Paul explained, roll off, meaning they've been buying back the debt, and now going forward, they're not going to be buying back the debt. Or they can. So depending upon, and that's one of Powell's statements, and that really, helped turn things a little bit, is that, he's got to be very conscious of how it rolls off. In terms of, the U.S. economy, this is, and as Paul said, it wasn't an economic situation per se as to what was currently happening. Remember, in September, markets hit, most of the indexes, a lot of them, U.S. growth index especially hit new highs. But the indicators, again, right here, these are leading economic indicators. And Paul, why don't you explain what some of the indicators are so our listeners out there will understand?
Sure. So the Conference Board Index is just a composition of 10 of the most prominent leading economic indicators. So it factors in average weekly hours for manufacturing, average weekly initial unemployment claims, manufacturer orders, new orders, building permits for private housing. It also includes the S&P 500, leading credit index, and then it also has some interest rate spread between a 10-year Treasury and 2-year Treasury. All of these that have been pretty reliable indicators on getting a pulse for where the economy is. So as you can see in this current economic cycle, we've seen it almost touch the zero line in terms of growth. But again, if you look at
during the expansion period, and this is
right.
Very recently that we saw it in 2015, almost touched zero, and then again in 2011, we almost. So it's not always a smooth. The point is, it's not always a smooth ride, right, John? I mean, we're going to have ebbs and flows, and as we go forward.
No, I mean even earlier this morning in Davos, Jamie Dimon expressed confidence that U.S. GDP growth could remain stable, over the course of the next 12 to 18 months. And he just used the terms that there are just, issues, I guess you could say, that are, both political and monetary that just need to be overcome in order for the economy to remain stable.
And the next slide, Paul, shows a very similar picture of what happened in 15 and what happened in 11.
Right. Again, for the quarter, if you look at the fact that, this composition, this is Bloomberg's Economic Surprise Index, and it has 6 subsets, and it shows us that, we did see, some deterioration in housing, real estate market, namely because of interest rates, right? We did see a freeze in lending in the fourth quarter. The industrial sector was negatively impacted as a result of trade war. And then, the retail sector and business surveys, because of trade, a lot of businesses backed off on their capital spending for the fourth quarter. However, labor market still resilient. We're still at record lows on unemployment, and personal consumption was actually pretty meaningful. So overall, the drawdown that we've seen in this index, doesn't necessarily corroborate with the drawdown that we saw in the financial markets.
When I look at indicators, I look at I was looking just even personally, plan a vacation later in a year, and moderately priced vacation, and a few of the trips I was looking at were sold out. You go to restaurants, it's very difficult to get reservations on the weekends unless you do it way in advance. You go to Chili's even. So, a lot of the economy, airplanes are full. Real estate, which you touched on, Paul, if I look at certain markets, a lot of people don't learn from history in terms of overbuilding. you look at New York City and all the industrial areas, they're building new high-rises and developing new apartments. I looked in Miami, same thing is happening. We drove across the state last week, and even in rural areas where there's more cows than people, they're putting up new developments, 55 and over communities. So,
it's very indicative of the labor market.
Right.
Strength of the labor market.
Yeah, and but I'm saying in real estate, we do get overbuilding when things are going well. You do get overbuilding, and then you get a slowdown, and it's cyclical, and you got to catch up to it. Demographics, everything has to catch up to it. So as we move forward in terms of a cycle, one thing you have to understand about, when we discuss a recession, there are opinions, and nobody knows until after the fact who's right or wrong, because they saw in the previous slides, you can have the economy slow and accelerate again. Different things, John, can cause the acceleration, such as a trade deal.
Sure.
That can cause an acceleration.
You can get an acceleration from a positive trade deal. We could get an acceleration from a more accommodative Federal Reserve. We can get an accelerated market if we get some kind of Brexit deal. If we get the government shutdown to end and find some compromise there.
Mm-hmm.
All of those could have some positive tailwinds to the market. At least I would say in the first half of 2019.
Yeah, that'd be a positive, and then again, as you've seen by the previous charts, I mean the economy will ebb and flow, and most economists don't know. I'll never forget the head of economics at MIT pounding his chest. I predicted the financial crisis. Problem was he predicted it in a New York Times article in 2001. I bought my house, my little farm I had in Hopewell in 2001. It never went below what I paid for it. And most real estate in the country never went below 2001. So timing is everything in a lot of these predictions. And, again, we'll talk later, but that's why you need to have the proper portfolio. But, we're mid-late cycle. We all agree with that in terms of where we are in the economic cycle. Right. At this point in time.
Right. I think this year we will start to see a transition of some of these indicators more toward later cycle. But overall, the Federal Reserve Senior Loan Survey metric that we follow still shows that major banks are still showing easy credit conditions, and which is very important because once credit becomes tight, that usually portends to the end of the business cycle, but we're still in mid-cycle, as far as that metric is concerned.
Yeah. So again, profits, right now with the decline, the tax cuts last year gave a big bump to earnings, which they won't have this year. But earnings expectations are still expected to be up 8 to 10% this year, and we ended, by a lot of forecasts. So we'll have to see how it all plays out because again, we have headwinds such as Brexit. We have headwinds such as the government shutdown. We have headwinds such as trade deals being ratified. So again, how this all plays out, we don't know until as it happens. But the geopolitical risks, we touched on a lot of these. China trade talks. I mean, that's I hear from a lot of clients about that. They gave us a reprieve for that in terms of an extension.
Right. I mean, the president and the administration are actively in talks with the Chinese. There's a March deadline for what I would call like a ceasefire, right? So as far as the tariffs are concerned, and hopefully they can come together with some type of a compromise by then.
And if they don't, they can always kick the can down the road and extend the deadline during negotiations.
Right. So I think the important takeaway is at this point, both regimes are looking for a win here because China's economy, has been very fragile as of late. So Xi certainly wants, to try to come to a conclusion. The premier, the president of China, and the current administration too also wants to show
that question
for the base. So as far as I'm concerned, I think that there will be some constructive resolution with regard to that. Of course, government shutdown, that is going to have some impacts already. That should probably cause GDP growth for the first quarter to decline. It's, not, we're certainly very, cognizant of the fact how stressful that is for those that are, undergoing, no paycheck for this duration. But at the end of the day, government spending, only equates to about 20% of GDP. So for the quarter, that should be, a nominal drag on the economy, which ultimately will get added back to next quarter. Hopefully, a resolution there will be swift.
I even heard, a side note of somebody who was supposed to close on the house. They didn't allow them to close on the house because of, they're not getting a paycheck. Somebody who has a significant income from a government job, the bank did not let them close. They kicked it down the road. So it's impacting a lot. My point is it can impact housing, it impacts retail sales, it impacts just airports. Yeah. For those traveling, make sure you give yourself really a good extra hour for traveling. In terms of, I hit on this a little bit earlier in terms of valuations. From a historical basis, where we are right now in the U.S. with what happened in the last quarter, John, valuations are still,
reasonable.
We're reasonable. I mean, we're below historical averages. Again, historical averages don't mean anything. We can go through a period of time where we're trading at 13 times earnings. But, historically,
globally, too. I mean, it's across all markets.
U.S. international.
Yeah, all markets, as far as, price to earnings are concerned, are all below their historical averages because, obviously, we've had a pretty steep sell-off, and we haven't seen a steep drop-off in earnings to go with it. So.
Yeah, and, a lot of the markets hit bear market territory, meaning small cap, NASDAQ, a lot of the indices during the quarter, which, it does happen. We just haven't had it happen since 2011, where we had a bear market, which is very unusual to go that many years without a bear. It doesn't mean that going forward the market's going to, have a challenging time. But again, we have a lot of headwinds and tailwinds, and we'll have to see how everything plays out. Paul, here, you and I were talking earlier today about emerging markets in terms of, the numbers seem a lot different for emerging markets on here because of...
Right, because they're using a price-to-book valuation. I mean, if we were to look at the PE of emerging markets, it's about 10 or 11 compared to the historical average of about 13. So you're still seeing a deep discount. Discounts to historical averages there, U.S. is trading about a 10%. International markets are about 17 to 20% on average. So, from a historical standpoint, things are cheap, or you could at least make the argument that the market is not excessively valued at this point.
Mm-hmm. Yeah, and now we're going to go into the fixed income area in terms of, what's happening. We hear a lot from clients, Sean, about, the inversion of the yield curve, and what that means is the 10-year Treasury is a lower interest rate than the 2-year Treasury. That's an inversion. And, we came close to that, but a lot of people think it's because if we do invert, which we haven't, we're going to have a recession immediately, and that's not the case.
Well, it's not immediate. It's one of the indicators of a potential recession going forward. If it inverted, it just means banks stop lending because they can't make money. But right now we just have a very flat yield curve. So we have the 2.5 spread briefly inverted, but the 2.10 spread is what we focus on as far as.
And it tightened and widened a little bit.
Right, and even after an inversion happens, equity markets have generally marched higher. It's, the recessionary mark usually occurs on average about a year plus after an actual inversion.
And the point here, that really hasn't.
Well, we haven't had an inversion yet.
Yeah, that hasn't. And we've seen inversions happen, and quickly they revert. because economic conditions improve. So, again.
Well, and now, of course, it doesn't mean they have to invert,
Right.
have a
Right.
recession either.
Recession, yeah.
And more importantly, Roy, I mean, this is one metric. In isolation, it is helpful, but in isolation, not as useful when you use corroborating data. I think that's the important thing.
Yep. So next we're just going to talk in terms of high yield debt. What that means is junk bonds. Everybody knows high yield debt is junk bonds. And Paul, we're talking even earlier about the leverage a lot of companies have attained over the past few years.
Yeah, this is something that's been on our our dashboard that we've been looking at. Causes a little bit of concern. Something that we're cognizant of going forward and how we're managing our fixed income. Over this current cycle with rates being so low, corporations leverage their balance sheet to mostly effectuate share buybacks. So the chart here to the left, you could see it shows that both M&A, that's mergers and acquisition, and non-M&A related BBB, which is investment grade rated debt, ballooned substantially over this cycle. Double, almost triple in aggregate if you look at the numbers. 1.8 trillion versus 600 billion at the start of January. Of 2009, that's correct. So if the rating agencies were to use the traditional leverage ratios for corporate debt, a lot of there could be a potential for rating downgrades down the line for investment grade corporate debt. And a lot of the rating agencies have sort of put an asterisk underneath saying, yeah, we understand that companies borrowed to effectuate share buybacks. We're looking at it. But it does give us a little bit of pause. Obviously, we're very aware of a lot of the negligence that went on in lending in 2006 and 2007. This isn't, I think, in that category, but again, it just gives us a little bit of concern. So, we've made the initiative here in the portfolios to stay away from investment grade, the lower rated investment grade corporate debt, because we think that that could manifest into ratings downgrades somewhere down the road. We are very devoid of high yield debt in our portfolios by and large, just because we think that the risk relative to the volatility and the potential for losses is greater than justified.
In terms of, we talk about as we go forward, the outlook for 2019, this is a forecast for the operating earnings of entities, consensus forecast, and also, again, a lot of this depends upon trade situation, tariffs. This is a variable that is, but these are the expectations. The next slide just really shows, expectations in terms of forecast. Paul, you and I were talking about, we're not expecting, at least government rates to skyrocket. You're seeing a very modest increase over a period of 2 years in interest rates.
Right. So these are projections that factor in, surveys from, major institutional investors. And given the fact that the Fed has, reduced their rhetoric, we do still expect the Fed to raise at least 2 more times. Again, we'll see what they do with their balance sheet and how that affects rates. But overall, we'll probably be, if we look at the 10-year Treasury, we're projecting probably 3.1% toward the end of this year. But short-term rates will also go up. And the spread between short and long-term rates should stay relatively narrow. Again, not really justifying taking the additional risk and buying longer dated bonds. And, that's the case abroad. If you look at Europe, you look at Germany and the UK, rates there are certainly, a lot lower than in the U.S.
On a German bond, you lose 0.5%. So, that's where the U.S. is desirable. The big thing is adhering to the financial plan. This chart just shows if you, in January of 2009, if you moved into cash and waited to get back in, the most money that ever flowed out of the U.S. stock market was the beginning of 2009, end of 2008. And, you got back in a year later, it hurts you. And if you stayed in cash, it hurts you even more. So, again, the key is to have a properly diversified portfolio. We did a major rebalancing at the end of October. 1st of November, and took some money from U.S. markets and bought emerging markets, which ended up being a good situation for clients. But again, you really need to have a portfolio that matches your strategy, John. I mean, that's what we do, and Paul, we do that constantly to make sure we have a financial plan, and then you can't predict markets. I mean, if you try to, it makes a fool of you every year.
No, even the most conservative investors, it's important to at least always have a toe or a foot in the water, so to speak, in different asset classes, despite volatility, because it's impossible to predict the beginning or the end of a.
Well, you look at what happened in the beginning of this year. I mean, this year, equity markets are up nicely in the first month to date.
Right.
So it's very, very challenging to predict. But the main thing we can predict is the financial plan by having a proper diversified portfolio that helps you withstand the storms. That I was with a client yesterday, and they were talking about a friend that had 100% in equities, and they're retired. And I'll never forget in 2008 doing an article for the Wall Street Journal. Dear Abby, what do I do? The couple had lost almost 70% because they were overweighted in areas that were more volatile. And my advice was go back to work. They were young. But the point is, if they didn't take the risks they took, they could have been retired at a very young age for the rest of their life. But they decided to, gamble and place bets.
And even worse is single concentration risk. Owning too much of one particular company.
Oh, you look at the company that was Soji that was just taken over. At one point in the last couple of years, it hit over 140, if I remember, and it was taken over. At a lot lower price. So, it's important that you diversify a portfolio especially if that money is going to be needed in retirement. So, again, thank you very much, and I'm going to hand it back to Cherie, and then we'll continue to keep you notified as the year goes on as to, what we believe is going to happen as this all plays out.
Thank you, Roy. Thank you for joining us on this webcast, and we look forward to continuing our series of these calls with you in the future. And if you missed any part of this webcast, a replay will be available on our website shortly. We really do appreciate your feedback, so please feel free to send us an email with your comments to pwm@prestigewmg.com. That's pwm@prestigewmg.com. Have a good afternoon. Thank you.